Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to the Expansive CEO podcast. And we have an announcement that I'll get to after I tell you that it's Investment Friday. Once again, we are recording this on Thursday, July 27th at 4:38 p.m. Just so you know what the benchmark is for what the markets are doing right now. But this will come out on Friday, July 28th. So the announcement, Brad Haines, CFA and FRM, and Chief Investment Officer at Juncture Wealth Strategies. We are going to be doing Investment Fridays every Friday. So that means if you have any questions, any wonderings that come up during the week, any crazy things happen in the stock markets that you want to get our take on between me and Brad, you will get to have that answer almost immediately, like every Friday. So Brad, how's it going, man?
It's going great. How are you?
I'm good.
West Coast is doing well. East Coast seems to be doing well.
Got slammed with rain like 5 minutes ago, and now it's done. So it's normal.
Yeah, there you go. That's an East Coast winter or a summer right there.
Yeah.
Super humid, a little bit warm, a lot of warmth all across the country. I mean, I was just in Scottsdale, Arizona yesterday, and it was brutal.
Was it still 116?
Yeah.
Okay, I was there last week, and it was 115 average up to 118 in Phoenix. It was terrible. And anyone who says, but it's a dry heat, said, so is your oven. Why don't you go sit in that for a while and see how that feels?
And it's worse because, as you know, one of my business partners lives in downtown Phoenix in one of the high rises, which is really beautiful because it overlooks the lights, it overlooks the city. It's gorgeous. However, on this night, we went out and it was probably 10 or 11 o'clock at night. So obviously the sun was down, but the heat was still reverberating. And he said, you got to come out here. And we stood out there for 2 minutes and the wind was so hot. It was cooking us. It was like a convection oven. And so again, 2 minutes was all we could really, before we tapped out and said, that's it. We got to go back inside to the AC. So
that was literally my experience. We went and saw, when I was there the other week, we went and saw The Little Mermaid in one of the movie theaters. Coming out of the movie theater, it was the same. It was like like a channel almost between the buildings. And so there was wind coming up off the hot pavement. And I said that I was like, it feels like a convection oven with hot wind coming off of 140, 145 degree pavement. Right. So,
yeah, it's something that I think Maricopa County, Arizona, but Phoenix specifically, Scottsdale, the metro area there, they're going to have to come up with a solution because they're creating that heat island, and it's not getting better. They're allowing developers to continue to increase the density. They're increasing development because it's a very touristy, construction focused economy. And eventually they're going to make it unlivable. It just will become unlivable, right? So, well,
we'll get to that in 2050 when Phoenix is dying.
Yeah.
We'll get there later.
Yeah, exactly.
What are the implications for the market? But for this week, so we've had some interesting things happen this week. What's our market update?
So a couple things, really, really important things happened this week. One, the Federal Open Market Committee, or you'll hear FOMC, which is the acronym, increased interest rates by 0.25%, or if you know industry speak, they say 25 basis points. So they increased the federal funds rate from a range of 5 to 5.25% to now 5.25 to 5.5%. They did that for the reason that, okay, inflation's come a long way in coming down to more reasonable levels, but there are certain parts of the national economy that are still just a little too sticky. So that was the first thing. The second thing was today, US GDP came out for the second quarter, and it was at 2.4%. That was stronger than what was expected, quite a bit actually. And most of that strength came from consumer spending and business spending. So that, I think, is going to give the Federal Reserve some pause to think about maybe we should continue to increase these interest rates a little bit more in the future, causing more downside. So obviously today, as that announcement came out, the markets were up, and then they sold off pretty diligently. Actually, after they decided they were going negative, they went negative pretty quickly. And then the third thing from the international markets was Japan's central bank, which has pursued a policy of yield curve control, is considering or thinking about allowing their yield curve to float a little bit more, to allow it to transition and to and that's kind of a big deal. That's a really big deal, since they've had that curve under lock and key for quite some time. So that increased our yields, because now our yields have to compete a little bit more with Japanese yields, which typically have offered extraordinarily low rates, so not very attractive to US based investors.
Okay, so let's get to this real quick, because I actually did have a client call and ask this question. So Bob in Huntsville, thank you for calling and asking this question, because we need to know what's going on. And so his literal question was, what's going on with Japan's interest rates, and why did a 0.5% increase for Japanese interest rates cause such a big fluctuation? That was his question. Did it, right? Did it cause that big fluctuation in our markets here in the US today? And the second part of that question was, like, that happened overnight and we were affected immediately. So that second part was, are we really that globally connected now, where, something happens in one of the other bigger countries GDP wise, and immediately we're feeling the effects in the US?
Great questions from Bob, as always. I'm going to say, number one, partially was it responsible for the downside? Absolutely. It was one of the key indicators. Two, are we that globally tied in? Absolutely. And really, the globe has always been economically tied in since the days of the first Silk Road, where you had economic turmoil in one area, whether it was a war or something, a disease, in fact, could affect every part of that route. As you had traders going on the Silk Road, they carried with them that turmoil and or those pathogens. So we've always been connected since those times. The difference between today and then is the speed of transmission, which today is seconds. It's seconds that we know that the Japanese central bank is going to increase their interest rates, and they're going to let their yield curve float a little more freely. That impacts our markets instantly today. So he's exactly correct that when that happens, the reason that caused some of the downside, and it ties into also that stronger than expected GDP report and the increasing interest rates. So all three of these are very, very related to what happened today in the markets. So the Japanese yields, which historically for the past 20 years have been not very attractive if you've hedged the currency, they've been really, really low. They've been really, really low. Okay.
Even negative for quite a while.
Negative to, longer term bonds, very low. Like, I think their low is 5 basis points on their 10 years. So I'll have to check that. So don't take that verbatim, but I'll have to check that number. But it was very, very low for a very long time. Well, now with them coming up and Japan being a fairly quote unquote safe lender because they fund all of their debt from internally. So their citizens, they save enough money to buy all of the Japanese debt that's issued. Wow. Well, now if yields start coming up, they become more and more attractive, or they could become more and more attractive to buyers, to investors, to central banks, other central banks that up until now have really bought US Treasuries. Well, now you go to the US Treasury market. Okay. Well, the US Treasury market went from the 10-year went from a 3.8% to over 4% in the last couple of weeks. So why? Well, now they have to start competing on a yield basis for those excess dollars. Now Japan stepped in as an alternative, as a substitute to US Treasuries to a certain extent. So it becomes that calculation that, oh boy, now we have to compete a little more on yield to gain investors. So higher yields. Okay, so Japan causes the yield curve in the US to shift up a little bit, offering more attractive yields. What happens? Well, then the US equity markets go, wait a minute, if Japan's growing strongly enough to do that, and our GDP came out stronger than expected based on business and consumer spending, maybe the interest rates that just were raised this week, maybe we're wrong. Maybe we should have higher interest rates for longer, and that could be a real problem for business profitability. So that's what happened is now equity investors are like, wait a minute, we may be here for a lot longer than we anticipated. Maybe we go to 6% on the yield on the interest rates for a little longer until we see layoffs coming. Okay. So that is kind of the thought process that created the dynamic today in the market, where we were up pretty decently early on, and then we sold off in a convincing manner. Now, also you have in the backdrop, we're on the back of this massive rally that's been up. We've run up 20%, 25% from the lows of October of 22. So, a lot of people have made some money. They're like, maybe I should just take some profits, just to wait and see. And generally, going into August and September is the most volatile periods in the equity market. So I think you have a lot of factors coming into play at this point.
So the other thing that you mentioned when we were talking before we were recording is this impending kind of weakness in the US market that could be an issue. What do you see in that regard? How far out and how long would it be until we maybe see that start playing out?
That's a great question. And I don't know. How's that for a great answer? The timing of it can be anywhere from 6 months to 24 months. So it's a wide range, which is why I say I don't know. Because if you look at US commercial banks, their loans and leases, okay, that's essentially the fuel, one, for inflation, but it's also the fuel for economic growth. If you track the growth in loans and leases on US commercial banks, it correlates very highly with economic growth. And if it goes down, it also corresponds with the money supply going down, meaning we're going to have inflation coming down, if not into deflation, which obviously is a very difficult environment for businesses to maintain their margins and maintain their levels of profits without doing something to cut their expenses. Well, oftentimes for U.S. consumers or U.S. companies, the biggest place to save money is on people. So again, that's forecasting out is, we're having disinflation. The CPI is at 3.1%, a little less than 3.1%. The headline year over year. A lot of that has to do with the base effect, where we had 9% inflation, and that is starting to roll off. So now we're at 3. But because our money supply has been declining, okay, so the growth has been negative. So that is the fuel for inflation. If that's going negative, inflation will come down. Okay. But also what comes down with that is economic growth. Okay. And the more that constrains businesses and their future profitability, the more likely we're going to have more layoffs, job openings start to get canceled, and that's going to start rolling through the economy. And so somewhere between 6 and 24 months, we're going to have a pretty difficult time having a growing GDP if something's not done.
What do you mean by if something's not done?
Well, the Federal Reserve is at an interesting point where they have inflation for the most part that has decelerated. Okay. In some measures, it's within their range. Other measures are slightly above it. But they can't wait for that inflation to get into their range before reversing policy. Because if they do that, those long and lagged effects, those variable effects they've been talking about, they'll miss the boat. They'll actually overshoot or undershoot. They'll go under their target of 2%. Okay. And they might hit deflation at some point if they don't course correct before. So if you look at the trend and you look at the things that are decelerating in price, it's really important to understand that if they don't start to ease financial conditions, either through quantitative cooling out the quantitative tightening, or by stopping or by just announcing they're not going to raise interest rates any further, then they do risk of overshooting by raising interest rates too high and thereby causing a problem.
Okay.
Putting us into a recession, which right now I think they could probably avoid if they act soon. But if they continue to increase interest rates over the next few months, that could end up breaking something, which means economic growth undershoots into a recession. We actually experience very low inflation, if not some outright deflation, and a lot of people start getting put out of work. And the unemployment rate, which arguably should not be at 3.5 to 3.7%, in a normal environment, it should be 4.5 to 5%. We'll start to see people hitting that range. Again, terrible for those individuals, but for the overall economy, not a bad place to be.
So what I'm hearing is this balance between, like, we're right at that precipice of what, we could tip either way. We could either go one more hike into, higher interest rates and potentially see that overshooting the mark and making it too difficult for businesses to grow, and bringing inflation down too far. So those are the pieces that I'm hearing all go together. Or we could say full pause. We're not going to raise interest rates anymore and see what the economy does with that information, making sure that we're not going to see a acceleration of inflation.
Right. And
if that happens.
That reacceleration, that possible reacceleration, is why the Fed is so nervous, because they're worried. If you take the job openings and and labor turnover survey, or the JOLTS survey is the acronym, if you take that JOLT survey and divide that by the number of persons unemployed in the US, that ratio right now is at 1.6, down from 1.9, but that's far too strong. Okay, that is far too strong. And I was just talking with a client yesterday, and he made the astute observation that there's a lot of people that are not coming back into the labor force. They retired early because of COVID and the COVID pandemic relief efforts. And he said, so with the shrinking labor force in the US, how are we going to not have some wage inflation? And he's absolutely correct. Now, one of the parts that I think he's missing is we have a lot of technology that is going to step in that void, and which is actually much less expensive than replacing another person, another employee. So inflation and productivity, which hasn't been all that terrific in the last couple of years, will reaccelerate. I think that's one of the reasons that we've heard a lot about the AI development, because it's going to be that next step in innovation for helping to replace diminishing worker counts. And a lot of people think, well, it's coming from my job. You know what? It might be, but at first it's coming for the jobs that there's no one there to fill. Like there's no one applying for that job because there aren't enough people. So they're going to have AI and robotics step into that void and fulfill those duties. So it's something that fear of the reacceleration of inflation that's keeping the Fed tighter than they should be. Now, I'm of the strong viewpoint that labor is a lagging indicator. I mean, when you're a business owner, you don't forecast out, many years in advance and then ramp up your business based on what you think is going to happen.
Unknown caller.
Sorry, excuse me. I should have
put that
on. So you don't do that. What you do is you start to see your business grow, your revenues are growing, and then you're like, oh, wow, I need more resources in this one particular area. Let's say it's operations. Okay, I need another operations person to help fulfill, our operations. That's what you do as a business, and you plan for that. You make budgets and all those types of things. So it's a little bit, jobs and labor is a little bit of a lagging indicator. Now, the problem also is it can be a leading indicator in the sense of spending, because the money they earn from their businesses go into their households. Those households oftentimes don't make those same budgeting decisions. They'll say, hey, we want to do this. They'll plan for it and do it. So it can be a very, very tricky balancing act, which is what the Fed is being required to do right now.
Well, I think that comment about jobs being a lagging indicator, I had never thought of it that way. And it's so on point because, I mean, what's the percentage? Is it something like 99% of all businesses in the United States are small businesses?
Exactly.
And a small business is, you could have 100 employees and still be a small business, right?
Correct.
So technically, that's how that goes. Yeah. Phones ringing all over the place here today. What's going on? But especially in a smaller operation, business owners are so much more, not that big corporations aren't thoughtful about hiring too, but when you're a smaller operation, you're very, very thoughtful about hiring most of the time. And so you are also very, very thoughtful about laying people off. And they're going to hold out on laying people off for as long as possible. So I can absolutely see, like, that makes total sense to me working with business owners, that you're going to be slow to hire, and then you're going to be, unless it's like you need to fire someone because it's not working out type thing, you're going to be really slow to fire those employees that you really don't want to let go of. So makes sense.
Absolutely. Absolutely. I mean, it's, as in Juncture Wealth Strategies, we have 11 employees, and um, all of them are great. And it would take a long time before we had to lay someone off. I mean, it's a terrible decision to have to make, but yeah, so, but we plan for that, and so it's something that I think most businesses do that to a certain, either informally or formally. And so, when you start to have things slow down, you start to see those revenues slow down. That's when you revise those budgets. That's when you revise those plans, and maybe you cancel a job that you have open, or you start to want to right size your labor force because maybe your revenues aren't growing nearly as much as you needed to. I mean, earlier this year we saw that or late last year, earlier this year in tech. They had overhired for the growth that they had expected from the pandemic till now. And so they got rid of, a lot of the large, Meta, Amazon, a lot of those companies got rid of a lot of talent because their revenues weren't coming in nearly as much as possible. And those have actually done the best this year, right? Partially because they did lay off a number of those individuals.
Interesting. I didn't make that connection either. Thank you for sparking all of these aha moments today.
It's what I try to do, Hannah. It's what I try to do.
Right? So interesting. Okay, so that is a beautiful place to wrap it up for this week. And I want to again say we are here and open for questions. Whatever comes up, we're going to be here every single week going over, what's been going on, what might be coming up, and, diving into this also gives us the opportunity to dive into a different education topic every single week as well. So if there's any thing that you've always wondered about or that you wanted to ask, a financial advisor or your financial advisor, and you just never felt comfortable asking for whatever reason, ask us. And we would love to, explain that on these Investment Fridays. So thank you for listening. Thank you for being here, Brad. And we'll see you next week.
Sounds good.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at hannah, HANNAH, @expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.